So I think when you ask the question, do we need to worry about Apple, it's do we believe that Apple is going to kind of return to the overall personality in which it traded in the fourth quarter of 2022? I am not of the belief that we will go back to that place. I think we're somewhere in the middle. I think that the enthusiasm, the excitement surrounding Apple needs to be somewhat tempered. If you are overweight Apple, I think you need to take a look at that. And I think at certain times in the market, you have to understand that balance is the right position. And that's the way I would approach owning Apple right now. I wouldn't be excessively long. I wouldn't believe that you're going to be able to short the stock because you're going to get it back at 130 where it was in the fall of last year. I just think it's middling or muddling around somewhat in this sideways range, and it's waiting ultimately for further catalysts down the road.
I think the biggest question, and Eric Johnston of Cantor mentioned it yesterday, Brian, on Closing Bell with me, the idea of whether Apple's too expensive or not.
Yeah.
Okay, its forward PE on January 1st was 20.5 times, okay? Today it's 29 times. It was over 30, as we know, at different points of this year.
Yep.
The 10-year historical average is 18.5. So on the first question, is Apple too rich? You say what?
I say at these levels, yes. Especially on a short-term basis, and you're probably surprised to hear me say that.
Yeah, I am actually.
But,
so you own it in two portfolios, just to be clear.
Yeah, but here's why. Joe brings up a great point. To really have an impact on your portfolio, you have to be overweight Apple. And I think to be overweight Apple is very dangerous because the kind of number that you're going to have is like a 9 or 10% of your portfolio, Scott. And especially considering how long duration assets are reacting to this higher 10-year yield. We've seen small cap stock do the same thing. I think over the near term, it's going to be difficult to be at that level, 9 or 10%. But as we've been saying, I think that we can get this stock cheaper. I think we can get tech cheaper, and I think stocks will probably pull back a little bit more. So at these levels, yeah, we're not adding.
So, Weiss, I want to back it up, if you will, with the valuation versus the growth rates in revenues, which have obviously been declining from where they were from peak, and significantly so. Okay, if you look at their revenue, their total revenues for, let's say, Q1 fiscal 23, they were down 5.5. Q2, they were down 3. Q3, they're expected to be down 1%, and that's for their fiscal year. That is versus increases across the board, and in some cases by massive numbers. So if the revenue growth is declining and the multiple is increasing, don't we have a problem?
Yeah, I mean, look, if you remove the name of the company, Apple, so you get rid of all the Apple sycophants, you'd say, what would I pay for this company where revenues have been declining? And you sure wouldn't pay anywhere near that multiple. You'd pay half the multiple. So then put the name Apple back on, and you say, you know what, there's a brand here. What would I pay that brand? You still won't come up to it. But actually, Scott, today, I think the action is not that they're raising the phone price by $100 in the face of a weak consumer and in the face of rising oil, which is going to take a greater share of consumer pocketbook. I think the bigger issue, frankly, is that there's a report in the Journal early this morning that the Chinese government banned government officials from using Apple devices. Now, putting that in perspective, I believe Apple is the largest employer in China. The phones are made mostly in China, assembled in China, yet they're saying, we don't care. Even though we essentially control the manufacturing of it, we don't want you using it. So the market's looking at it and saying, is that the tip of the iceberg? Is this going to aggravate relations between Apple, of which Tim Cook has been a master at dealing with the Chinese government, and will lead to a further decline in Apple business in China, where they get 20% of their revenues. So to me, that's the much bigger issue with Apple today. So, but what comes out of that is you're still going to want to be in tech. I don't think people that want to outperform, I'll disagree with Brian, have a 9 to 10% weighting in Apple, particularly at these levels. That'll be better for the Metas, for the Microsofts, for the Googles that don't have that dependence on China, because it's not going to be a Russia-Ukraine situation, but that could be the direction that continues to go.
And let's just be clear, Liz, as I turn it to you, and we can broaden it out a bit. No one here is suggesting in any way that Apple's not a great company. Apple's got great products. Apple's got a great balance sheet. Apple's got arguably the most powerful installed base in the history of any consumer product company ever. Mm-hmm. All that said, you still have to justify the price for something, okay? Now, is the valuation, do you think, how should we judge the valuation of all of those stocks relative to where the revenue growth rates have gone over the last year plus?
Well, I think the market is doing it correctly by judging it based on growth and judging it based on what yields are doing and how expensive capital has become, and the fact that these long-duration assets are getting hit as yields rise.
I know, but not that bad, though.
Is a rational way for it to happen.
I know, but this stock...
It's pretty orderly.